Hi, welcome to this podcast for Chapter 7, Learning Objective 10. Explain common techniques employed to control cash. And the primary purpose of this podcast is to focus on the bank reconciliation. So again, management faces two problems in accounting for cash transactions. One is to establish proper controls over who can authorize transactions and therefore prevent unauthorized transactions. And we need to manage cash and our cash transactions. So the bank account helps us do this. Obviously, it gives us control over cash. A company that is making a payment via check has much more control in place than somebody who is doing it by physically paying cash. So the way companies do it is they have a general checking account. The purpose of the checking account is not only physical custody of the cash, but also there is a paper trail of the ins and outs of cash from that account. Collection float is something that companies are concerned about. Collection float is the time it takes for a customer to mail a check in, the company to receive it, deposit it into their checking account, their bank. Their bank then sends it back to the customer's bank through some clearing process. They find out that the funds are good, and then the company gets credit for those funds. That's called collection float, and that could take a considerable amount of time. And so companies are looking to reduce the float time. Oftentimes they do that through a lockbox, meaning that customers think they are sending in a check payment to the company because it has the company's name in some P.O. box. But what is likely happening is that it's going directly to a bank. And so the bank is receiving that payment on behalf of the company and immediately depositing it into their account, and that's reducing some of that float. And we talked about petty cash in a prior podcast. Physical protection of cash balances. We should minimize the amount of cash on hand. We only want to have our petty cash on hand and whatever we would need for the day's receipts. We may keep funds in a vault or safe or some kind of a locked cash drawer. We want to transmit those receipts to the bank as soon as practical. We may make deposits every day. And we want to do a periodic reconciliation. So generally, once a month, we want to do a bank reconciliation. We do this during our regular month-end close. So we're doing a bank reconciliation, making the adjusting entries, and having, again, control over our cash. This illustration is in your textbook, but it gives you kind of a format of the way we would do a bank reconciliation. Recall that we have two balances of our cash, two records of our cash. We have the balance of the bank statement, and we have our balance in our cash ledger, and that's really our unadjusted cash balance. And then, of course, the items that reconcile it. Alright, so bank reconciliation. The purpose of this is there are two records of a business's cash. The cash account in the general ledger and our bank statement. The amounts are usually different. The reason they are different is usually because of time lags, meaning an item has been recorded in one record but not in the other. The bank reconciliation helps explain the differences. So some of the reconciling items you can see here. A deposit in transit. Let me explain what that is. When the when the company receives a deposit and debits the cash account, that then they go and deposit that in the bank. It is possible if they're doing that over the weekend, though, the bank won't show that deposit until the next business day. So if our month end happens to fall on a weekend, the company would record that deposit in one period and the bank would record it in another. so it becomes a reconciling item. It is a deposit in transit. Outstanding checks, if you're not familiar with this term, when you write a check to pay a bill or an expense, it usually takes a few days to clear your account. So when you write it, that is a credit to your cash ledger account, but it won't be reduced from your bank statement balance until it clears. And so in the interim, it is an outstanding check. And then bank memoranda are the items the bank is aware about and have either added or reduced from our bank account, but we have not yet recorded in our ledger. And finally, errors could occur. Okay, so the reconciliation process. We look at our beginning balances, our month-ending balance from our bank statement, and then we adjust it by the items that the book knows about, meaning they've been recorded in the book, but not yet in the bank. So we add deposits in transit, we subtract outstanding checks, and then we would add or subtract bank errors, depending on the nature of the error. And that will give us an adjusted balance for our bank statement. We then start with our unadjusted cash balance. So if you think back to our accounting cycle, we would have a cash balance from our unadjusted trial balance. Then we would add to it any collections that the bank has done on our behalf. We would subtract any NSF or bounced checks that our customers have written. We would subtract any other fees that we've been charged by the bank. And then we would add or subtract any book errors that we've discovered. And then that would give us a corrected or adjusted balance. And these two balances should be the same. All right, let's look at this example. Laird Company shows a balance per the books of $15,907.45. So that's what their bank statement shows. Our book balance, and again I'd like to call that the unadjusted trial balance, is $11,589.45. So let's go ahead and we're going to reconcile that, and of course we have some information here as well. One of the things we've discovered is there's a deposit in transit. There are some outstanding checks. There is an error, and the bank has charged us or collected on our account, and we need to record those. Okay, so let's use this information to do that. So here's our bank statement balance. Here's our book balance, again the unadjusted balance. We add deposits in transit. We subtract outstanding checks. And that's going to give us a balance, which we don't have yet. Okay, let's take a look. Let me go back. I'm going to look a little bit closer at that error. Okay, Laird wrote check 443 for $12.26, and the bank correctly paid that amount. So we know the correct amount of the check was $12.26. However, Laird recorded it as $12.62. So I want you to think about the cash key account. We should have credited our cash account $12.26. We actually credited our cash account $12.62. So we need to add back or debit or increase our cash balance by the difference, which is the $36. There was an NSF check. I guess I should look at those too. We had an NSF check of $425.60. Our customer wrote us a check that wasn't any good. We were charged $30 for printing. The bank collected a notes receivable of $1,000 on our behalf, plus $50 interest, minus a $15 fee for doing that. Okay, so the NSF check reduces our cash balance We originally had debited our cash when our customer had paid us. We now find out the check is no good, so we credit our account. The bank service charge reduces our cash balance, and the collection of the notes receivable increases our cash by $1,035. So we now get adjusted cash balance of $12,204.85. All right, let me go back to this. So this is step one in the bank reconciliation process. We now know what the balance in our cash account should be. It should be $12,204.85. The problem we have is, though, that it is still $11,589.45. So we have to make adjusting entries for these four items in order to get the proper adjusted balance in our books. So let's go ahead and do that. All right, let's get this one all out here. So we remember the bank collected $1,035 for us, so we're going to debit cash $1,035. We know that $1,000 of that was the notes receivable, so we're going to credit that. Once we've collected it, our customer doesn't owe us that anymore. We know that $50 was interest revenue, so we're going to credit that. And the bank charged us a bank fee to collect it, so we're going to debit miscellaneous expense for that amount. And so that journal entry balances. Another item we had was the mistake that we made was for payment on an account. So originally we had debited accounts payable by $36 too much. So now we're going to debit cash and credit accounts payable for that amount to get the right balance again. Our customer doesn't owe us, the customer paid us with a check that wasn't any good. So that doesn't get the customer off the hook from owing us. So we would debit accounts receivable for the amount the customer owes us, and we would credit cash to reduce our cash balance. And the last one, of course, was the bank service charge, miscellaneous expense, and a credit to cash. Once we post all of these transactions, we had our unadjusted balance. We post these four adjustments, and now we have an adjusted trial balance, which we will then use in the financial statements to report our cash balance of $12,204.85. Now there's one more thing I want to show you, so I'm going to go back a little bit to the reconciliation process. Notice first of all that we didn't do any adjusting entries for these items. We didn't adjust for the deposits in transit. We didn't adjust for the outstanding checks. The reason we didn't do that is because our books already know about that deposit, and they already know about the outstanding checks. So these are just reconciling items for the bank. The items that we need to make adjusting entries for are the items that reconcile our book. And here is a little trick that will help you know when you're doing the adjusting entries when you debit and when you credit cash. If in the adjusting entry process you increased, in the bank reconciliation process you increased cash, then in the adjusting entry that is going to be a debit to cash. If you decreased cash, then that is going to be a credit to cash. And again, this is the debit to cash. And we'll look at those real quick again. We debited cash for that $1,035, we debited cash for the $36, we credited cash for the $425, and we credited cash for the $30.